If you are 65 years old or older, there is a very good chance that you are giving the government money that you do not have to give. This is not a secret. It is not hidden in some buried law. It is right there in the tax code, but most seniors never hear about it. Their tax preparer does not mention it. Their neighbor does not mention it. And their monthly letter from the IRS certainly does not mention it. So billions of dollars in tax benefits go unclaimed every single year by people who worked their whole lives and played by the rules. That changes today. I'm going to walk you through every single tax benefit that you qualify for as a senior. I'm going to explain it so plainly that you will be able to explain it to your grandkids. And I'm going to give you a clear step-by-step plan for making sure you get every single dollar that belongs to you. Stay with me because this information could put thousands of dollars back in your pocket this year alone. Let me start with the most common misunderstanding. Most people think that when they turn 65, something magical happens and the government just stops taking their money. That is not how it works, but something very important does happen. The tax code gives you new rights, new deductions, new credits. These are not gifts. You earned them. You paid into the system for decades. This is your money coming back to you. If this video is helpful to you, if you believe that seniors deserve to know the truth about their own money, please hit the like button. That tells YouTube that this kind of content matters. That helps other seniors find it. And I promise you, there is a senior right now who really needs this information and does not know where to look. I want to tell you about 3 people I know, 3 real seniors who thought they were doing everything right. The first one is Margaret. She is 72 years old. She worked as a school teacher for 38 years. She has a small pension. She gets Social Security. And every year she pays roughly $800 in federal income tax. She never questioned it. She figured that was just what you do when you have income. But Margaret qualifies for something called the credit for the elderly or the disabled. This is a direct reduction of the tax she owes. If her income is below a certain level, she could reduce her tax bill by up to $7,500. That is not a small number. That is a life-changing amount of money for someone living on a fixed income. Margaret had no idea this existed. Her tax preparer never mentioned it. She found out about it only because her daughter saw a flyer at the library. The second person is Robert. He is 68. He worked part-time after he retired because he got bored and because he wanted a little extra money for travel. He made about $18,000 in a year from his part-time work. He paid taxes on every dollar and thought that was normal. But Robert qualifies for something that can raise his standard deduction by thousands of dollars simply because he is over 65. That means he could have taxed a much smaller portion of his income or possibly no income at all. He did not know this, so he paid more than he had to, every single year, for 5 years in a row. The third person is Linda. She is 67 and she rents her apartment. She pays $12,000 a year in rent. She also pays medical bills that eat up a big chunk of her fixed income. She never thought she could deduct any of this on her taxes. She thought deductions were only for people who own homes or who run businesses. But there is a deduction for medical expenses that can be incredibly valuable for seniors. Linda was never told about this. She lost thousands of dollars she did not have to lose. These are not rare cases. These are ordinary people, and what happened to them is happening right now to millions of seniors across this country. They are paying taxes they do not owe because they do not know the rules, and that is what we are going to fix together. I want to hear from you. Have you ever paid a tax bill and felt like something was not right, like you were paying too much for what you had? Type yes or no in the comments right now. I read every single comment and I will be responding to as many as I can. You are not alone in this. Now let us go step by step through every tax benefit you qualify for. I am going to start with the one that affects the most seniors and works its way down. Keep this in mind as we go. These are not suggestions. These are the law. You have a right to these benefits. The only question is whether you know about them. The first and most powerful benefit is the increased standard deduction. Here is how it works. Every single taxpayer in America gets something called a standard deduction. This is the amount of your income that the government says you do not have to pay taxes on. For most working people under S. 65, the standard deduction is around $14,000. That means if you make $50,000, you only pay taxes on $36,000. The $14,000 comes off the top tax-free. That is the basic idea. But here is what the IRS does not tell you when they send your form. If you are 65 or older, you get a bigger standard deduction. Not a little bigger, a lot bigger. The government adds several $1,000s onto your standard deduction simply because you are older. This is their way of recognizing that as you age, your costs go up and your ability to earn more money goes down. It is not charity. It is built into the law. For the current tax year, if you are 65 or older, your standard deduction is higher by several $1,000s compared to someone younger with the same filing status. That means a larger portion of your income is tax-free. If you are married and both spouses are 65 or older, the increase is even bigger. This alone could reduce your tax bill by hundreds or even thousands of dollars depending on your income level. But here is the catch. You have to know to claim this. It does not happen automatically. If your tax preparer is not paying attention, they might file your return using the regular standard deduction and leave money on the table. Make sure you are subscribed to this channel so you do not miss the next video. I'm going to keep covering tax issues that affect seniors in 2025 and beyond. The laws change. New credits appear. New deductions get added. You need to stay informed. Hitting subscribe takes 2 seconds, and it means you will not miss a single update. The second major benefit is the credit for the elderly or the disabled. This one is a real game changer, and yet almost nobody talks about it. A tax credit is different from a deduction. A deduction reduces the amount of your income that gets taxed. A credit reduces the actual amount of tax you owe dollar for dollar. That is a much bigger deal. The credit for the elderly or the disabled is worth up to $7,500 for married couples and up to $5,000 for single people. Let me say that again. This credit can reduce your tax bill by $7,500. That is not a rounding error. That is a car payment. That is 6 months of groceries. That is a significant portion of your annual income if you are living on a fixed budget. But there is a catch. This credit has income limits. You can only claim it if your income is below a certain threshold. The threshold is different for single filers versus married filers, and it includes not just your wages but also your pension income, your investment income, and half of your Social Security benefits. This is important because many seniors think that Social Security does not count as income for these purposes. That is not always true. Half of your Social Security benefits are included in the calculation that determines whether you qualify for the credit. So here is what you need to know. If your total income is relatively low, meaning below roughly $30,000 for a single person or below roughly $40,000 for a married couple, you very well may qualify for this credit. And even if your income is a little bit above those thresholds, it might still be worth checking because the credit phases out gradually. There is a range where you might qualify for a partial credit even if you do not qualify for the full amount. The way to find out is simple. Look at your tax return from last year. Add up all your income sources, include half of your Social Security, include any pension income, include any interest or dividend income, include any wages from part-time work, then look at the thresholds for your filing status. If you are below the threshold, claim the credit. If you are close to the threshold, do the calculation to see if a partial credit applies to you. This is not complicated math. You can do it with a basic calculator and about 20 minutes of your time. Are you finding this helpful? I want to know because I am going to keep going and I want to make sure I am covering the topics that matter most to you. If this information is valuable, please share this video with a friend or a family member who might also need it. There is a good chance someone you know is overpaying their taxes right now and does not realize it. The third benefit is something that affects seniors who work part-time after they retire. Many people think that if they go back to work, even part-time, they will lose their Social Security benefits or face huge tax bills. That is not always true, but there is a specific rule that can help you keep more of your money. Here is how it works. If you are between 65 and 72 years old and you earn income from work, there is a portion of that income that you do not have to pay taxes on. This is called the Senior Work Income Deduction. It is not huge, but it can make a meaningful difference. If you are earning $15,000 or $20,000 from a part-time job, the amount of that income that gets taxed can be reduced by a few $1,000s. That means you keep more of what you earn. The reason this matters is that many seniors avoid taking part-time work because they are afraid of the tax consequences. They think that any extra income will be fully taxed and will push them into a higher tax bracket. That fear keeps them from earning extra money that they could really use. But the reality is that the tax code has built-in protections for seniors who want to stay active in the workforce. These protections are real, and they are available to you. Do not let fear of taxes stop you from making money. Now let us talk about medical expenses, because this is where a lot of seniors leave money on the table. The IRS allows you to deduct medical expenses that exceed a certain percentage of your income. For most seniors, that threshold is around 7.5% of your adjusted gross income. So if your income is $50,000, you can deduct medical expenses that exceed $3,750. That includes things like doctor visits, hospital stays, prescription drugs, dental work, eye exams, hearing aids, and long-term care costs. This is incredibly important because healthcare costs for seniors are not small. Medicare covers a lot, but it does not cover everything. Supplemental insurance helps, but there are still out-of-pocket costs. And as you get older, those costs tend to go up, not down. The medical expense deduction can help offset some of those costs, but you have to know it exists. You have to save your receipts, and you have to report it correctly on your tax return. One thing that many seniors do not realize is that you can deduct medical expenses for your spouse as well as for yourself. If your husband or wife has high medical costs, those count toward your deduction too. And if you're paying medical expenses for a dependent parent or another family member who lives with you and depends on you for support, those expenses can also count toward your deduction. This is not widely known, but it is clearly written in the tax code. If you are watching this video and you realize that you might qualify for a deduction you did not claim in previous years, I need you to know something. You might be able to go back and amend those returns. The IRS generally allows you to file an amended return within 3 years of the original filing date. That means if you overpaid your taxes in the last 3 years because you missed a deduction, you might be able to get that money back. It takes some time and some paperwork, but it can be worth it. Keep watching, and I will explain exactly how to do this. Now let us talk about something that affects a huge number of seniors: property taxes. If you own your home, you are probably paying property taxes every year, and those taxes can be significant. In some parts of the country, the annual property tax bill on a modest home can be $5,000 or $10,000. That is a lot of money for someone on a fixed income. But there are programs that can help. Many states offer property tax exemptions or credits for seniors. These programs vary widely from state to state, but the basic idea is the same. If you are over a certain age and you own your home, the state will either reduce your property tax bill or give you a credit that you can apply against your state income taxes. Some states have very generous programs. Others have programs that are more limited, but almost every state has something. For example, in Florida, seniors over 65 can get a property tax exemption if their home is worth less than a certain amount, and if they have lived there for a certain number of years. In Texas, there is a school district property tax exemption for seniors that can save you thousands of dollars every year. In California, there is something called the homeowner's property tax exemption, plus additional programs for seniors with low or fixed incomes. In New York, there are several programs including something called the Enhanced Star Exemption that can substantially reduce property taxes for seniors. The rules are different everywhere. That is why I want to spend some time going through the different states and what they offer. But the first step is to find out what your state offers. Go to your county assessor's website or call their office and ask specifically about senior property tax programs. Write down the name of the program and the eligibility requirements. Then check whether you qualify. Do not assume you do not qualify. Some programs have income limits, but many do not. Some programs are only for homeowners with very low property values, but others apply to homes of any value as long as you meet the age requirement. Before we go further, make sure you subscribe. I am going to keep making videos like this one that break down complex financial topics in plain language for seniors. You do not want to miss the next one because it might be the one that saves you the most money. Let us talk about the states one by one. I am going to cover the most common situations, but keep in mind that this is not a complete list. There are 50 states, and each one has its own programs. But I can give you a sense of what is available in the major states where most seniors live. Florida is a huge destination for retirees. If you live in Florida and you are 65 or older, you might qualify for an additional homestead exemption. This is on top of the regular homestead exemption that all Florida homeowners get. The additional exemption can be worth several $1,000s depending on your income and the value of your home. Florida also has programs that freeze the assessed value of your home once you reach a certain age, which means your property taxes do not go up as your home value increases. This can be an enormous benefit over time. California has several programs for seniors. The homeowner's exemption reduces the assessed value of your home by at least $7,000, which saves you money on your property taxes every year. Beyond that, California has the Property Tax Postponement Program, which allows seniors with limited income to postpone paying their property taxes. You have to pay the taxes eventually, but the state covers them in the meantime, and you do not have to worry about losing your home because of a tax bill you cannot afford. Texas does not have a state income tax, which is great news for seniors, but Texas does have significant property taxes. The good news is that Texas offers a school district property tax exemption for homeowners who are 65 or older. This exemption applies to the school district portion of your property tax bill, which is often the largest portion. In many cases, this can save you $1,000 or more per year. Texas also has a tax ceiling that freezes the amount of school district property taxes you pay once you turn 65. Even if your home value goes up, and even if tax rates go up, your school district tax bill stays the same. That is a powerful benefit. New York has several programs for seniors, including the Enhanced STAR program, which gives an extra exemption on school taxes for seniors with incomes below a certain threshold. There is also the independent living tax credit for seniors who have certain disability-related expenses. And New York has property tax exemptions for seniors who live in certain types of housing, including co-ops and condos. Illinois offers a homestead exemption for seniors that reduces the equalized assessed value of a home. Illinois also has something called the Senior Citizens Real Estate Tax Deferral Program, which allows seniors to defer paying a portion of their property taxes. The state pays the taxes on your behalf and puts a lien on your property. You eventually have to pay it back, but you do not have to come up with the cash when you are on a tight budget. Pennsylvania has a program called the Property Tax Rent Rebate Program that sends rebates to seniors and people with disabilities who rent or own their homes. The rebate amount depends on your income and your property taxes or rent payments. This program has helped millions of seniors in Pennsylvania, and it is one of the most generous programs of its kind in the country. Ohio has something called the homestead exemption that can reduce property taxes for seniors who own homes. The income limits are fairly generous, which means a lot of seniors can qualify. Ohio also has tax credits for seniors who make certain home improvements that increase the energy efficiency of their homes. Georgia has several senior tax benefits, including a homestead exemption that can significantly reduce the assessed value of a home for seniors over 65. Georgia also has a property tax freeze that prevents the assessed value of your home from increasing as long as you continue to own and live in it. North Carolina has a homestead exemption for seniors that reduces the property tax on their primary residence. The income limits are designed to help seniors with moderate and low incomes. North Carolina also offers a circuit breaker program that limits how much your property taxes can increase from one year to the next. If this information is helpful to you, if you are learning things about your state that you did not know before, please hit the like button right now. That helps more people find this video. And leave a comment and tell me which state you live in. I read every comment and I will respond to as many as I can. Now let us move to another important topic: charitable giving. Many seniors give money to their church, their synagogue, their mosque, or their favorite charity. What a lot of seniors do not realize is that these donations can be deducted on your taxes. And for seniors who are already taking the standard deduction, there is a special rule that makes this even more valuable. Here is how it works. The standard deduction for a single senior over 65 is roughly $15,000 or more depending on the year. For a married couple both over 65, it is roughly $30,000 or more. If your total deductions from mortgage interest, state taxes, charitable giving, and other items are less than those amounts, you probably take the standard deduction every year. That means you do not get to deduct your charitable contributions. But there is a way around this. You can take a special deduction called a qualified charitable distribution. This only works if you are 70 and a half or older, and if you have an IRA. But if those requirements apply to you, you can transfer money directly from your IRA to a charity without having to pay income tax on that transfer. The amount goes straight from your IRA to the charity. It counts toward your required minimum distribution for the year, but it does not count as taxable income. And it counts as a charitable deduction even though you are taking the standard deduction. This is a huge benefit that most people do not know about, It can allow you to give more to your favorite charity while also reducing your tax bill. It is a win-win. If you are over 70 and a half, if you have an IRA, and if you give to charity, this is something you absolutely need to look into. Talk to your tax preparer. Talk to the financial institution that holds your IRA. Ask them specifically about qualified charitable distributions. This could save you thousands of dollars in taxes, and it could also allow you to give more money to the causes you care about. Let me ask you something. Have you ever donated to a charity and not deducted it on your taxes because you thought you did not need to since you take the standard deduction? If that is you, I need you to check into the qualified charitable distribution rule. That might change everything for you. Type comment in the comments and tell me you want more information on this topic. I will make sure the next video covers it in detail. Now let us talk about something that a lot of seniors worry about: capital gains tax. When you sell something like a stock or a piece of property that has gone up in value, you usually have to pay tax on the profit. This is called capital gains tax. But here is something very important that many seniors do not know. The tax rate on long-term capital gains is lower than the tax rate on ordinary income. That is good. But there is also a special rule for seniors. If you are 55 or older and you sell your primary residence, you can exclude up to $250,000 of profit from your taxes. If you are married, you can exclude up to $500,000 of profit. This is huge. It means that if you have lived in your home for many years and it has increased in value, you might be able to sell it and keep a large portion of that profit tax-free. The rules for this exclusion are specific. You have to have owned the home for at least 2 years. You have to have lived in it as your primary residence for at least 2 of the last 5 years. And you can only use this exclusion once every 2 years. But if you meet those requirements, this can be one of the most valuable tax benefits available to seniors. This is especially relevant for seniors who are thinking about downsizing. A lot of seniors sell their family home and move to a smaller place or to a retirement community. If you have lived in your home for decades, the value has probably gone up a lot. The profit from that sale could be enormous. And if you understand the exclusion rules, you might be able to keep most of that money instead of giving a big chunk of it to the IRS. Let me give you a real example. Imagine you bought your home 30 years ago for $150,000. You sell it today for $550,000. That is a profit of $400,000. If you are single, you can exclude $250,000 of that profit. That leaves $150,000 of taxable profit. The capital gains tax rate on that is lower than your ordinary income tax rate. But even so, you are keeping $250,000 tax-free. That is a massive benefit. Are you finding value in this information? If you are, please share this video with someone you care about. There is a good chance that a friend or family member is also overpaying their taxes and does not know it. You could help them by sharing what you are learning here. Now let us talk about something that affects seniors who have to pay for long-term care. This is one of the biggest financial threats facing seniors today. The cost of a nursing home or an assisted living facility can wipe out a lifetime of savings in juice. A few years, but there is a tax benefit that can help offset some of those costs. Medical expenses include the cost of long-term care if the care is medically necessary. This means that if you or your spouse is in a nursing home or an assisted living facility for medical reasons, those costs can be deducted as medical expenses on your tax return. This applies to the cost of the room and board as well as the medical care provided by the facility. But here is the catch. The medical expense deduction only applies to the extent that your total medical expenses exceed 7.5% of your income, and you have to be able to itemize your deductions to use it. This means that for the deduction to be valuable, your medical expenses have to be very high or your income has to be very low. In many cases, seniors in nursing homes do qualify for this deduction because their expenses are so high. There is another option. Some states allow you to deduct the cost of long-term care insurance premiums. This is different from the federal deduction. It is a state-level deduction that can reduce your state income taxes. The rules vary by state, but if you are paying for long-term care insurance, it is worth checking whether your state offers a deduction for those premiums. One more thing on this topic. If you have a health savings account, you might be able to use it to pay for long-term care expenses. Money you take out of a health savings account for qualified medical expenses is tax-free. This includes many long-term care expenses. If you have an HSA and you are paying for long-term care, talk to your tax preparer about whether those expenses can be covered with HSA funds. Subscribe now if you have not already. I am going to keep making videos about senior finances, and I do not want you to miss any of them. This is information that can genuinely change your life and the lives of people you love. Let us move on to something that affects a lot of seniors who are still working or who run small businesses. Self-employment tax. If you are self-employed, meaning you work for yourself, and you do not have an employer withholding taxes from your paycheck, you have to pay both the employer and employee portions of Social Security and Medicare taxes. This can add up to a significant amount of money. But there is a special rule for seniors. If you are self-employed and you are 65 or older, you might be able to reduce the amount of self-employment tax you pay. This is a technical rule, but it can make a meaningful difference for seniors who are still working. The way it works is that you get a deduction for the employer portion of the self-employment tax. This reduces your net earnings from self-employment, which reduces the amount of Social Security and Medicare taxes you owe. It is not a huge savings, but for someone who is self-employed and earning a modest income, it can help. Another area that affects seniors is the deduction for business expenses. If you are self-employed and you work from home, you might be able to deduct home office expenses. If you use your car for business purposes, you might be able to deduct mileage. If you buy equipment or supplies for your business, those might be deductible. The rules are complicated, but the potential savings are real. Do not assume that because you are retired you cannot claim business deductions. If you are doing any kind of work for pay, those expenses might be deductible. Now let me talk about something that a lot of seniors overlook: state income tax treatment of Social Security. Here is what you need to know. Your Social Security benefits are taxed at the federal level, but they might also be taxed at the state level depending on where you live. Some states tax Social Security benefits the same way the federal government does. Some states tax only a portion of your benefits, and some states do not tax Social Security benefits at all. This matters because if you live in a state that does not tax Social Security, you could save thousands of dollars per year compared to someone with the same income living in a state that fully taxes Social Security. This is one of the reasons why many retirees choose to move to certain states. It is not just about the weather. It is about keeping more of their money. For example, if you live in Michigan and you receive $50,000 in Social Security benefits, you might owe state income tax on a portion of those benefits. But if you move to Florida, you pay zero state income tax on your Social Security. That is a big difference. For a married couple with $50,000 in Social Security income, moving from Michigan to Florida could save them $2,000 or more per year in state taxes. That adds up over time. 13 states currently tax Social Security benefits in some way. Those states are Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, North Dakota, Rhode Island, Vermont, West Virginia, and Wisconsin. If you live in one of these states, check to see how they treat your Social Security benefits. Some of these states have income thresholds that reduce or eliminate the tax if your income is low enough. Others offer credits that offset some of the tax. Know the rules in your state so you can plan accordingly. Let me pause here and ask you something. Do you know how your state taxes your Social Security benefits? If you are not sure, type "not sure" in the comments. I will respond to as many comments as I can, and if there is enough interest, I will make a state-by-state breakdown video that covers exactly how each state treats Social Security income. Now let us talk about one of the most valuable and least known tax benefits for seniors: the special valuation limit for estate taxes. I know this sounds like something for rich people, but hear me out. There is a rule that can help you pass more of your wealth to your children and grandchildren without the government taking a big cut. When you die, the value of your estate is calculated. Anything above a certain threshold is subject to estate tax. That threshold is very high. For most people, their estate will not come close to it. But there is something important that many seniors do not realize. If you own a family farm or a family business, there is a special valuation rule that can dramatically reduce the value of your estate for tax purposes. This rule is designed to keep family farms and family businesses in the family, by preventing the IRS from valuing them at their full commercial value. If you own a farm or a business and you are thinking about passing it on to your children, this is something you need to talk to an estate planning attorney about. The rules are complicated, but the potential savings are enormous. In some cases, The difference between using this special valuation and not using it can be millions of dollars in estate taxes. This is not something to figure out at the last minute. You need to plan ahead. Even if you do not own a farm or a business, you should know about the basic estate tax threshold. The threshold changes from year to year. It is currently in the millions of dollars. Most seniors will not hit that threshold, but it is good to know where the line is so you can plan accordingly. Let me now talk about something that is very relevant for seniors who are thinking about their legacy. Charitable giving through a donor-advised fund or a charitable remainder trust. These are advanced strategies, but they can be incredibly powerful for seniors who want to give money to charity while also getting a tax benefit. A donor-advised fund is essentially a charitable investment account. You put money into the fund and get an immediate tax deduction for the full amount. Then you recommend grants to your favorite charities over time. The money grows tax-free in the fund. This is a great way to bunch your charitable deductions in one year to get a bigger deduction while spreading your actual giving over many years. A charitable remainder trust is more complicated, but it can provide income to you for life while ultimately giving the rest to charity. The tax benefits are significant, but these are sophisticated tools that require professional guidance. If you are considering either of these strategies, talk to a financial advisor who specializes in charitable giving. The fees are worth it because the potential tax savings can be enormous. I want to make sure you are getting the most value from this channel. Please make sure you are subscribed and that you have notifications turned on. Every time I upload a new video, you will get a notification, and I upload new videos regularly. The information I share can save you money year after year. Now let me talk about something that affects seniors who have investments: the tax treatment of dividends and interest. If you have a portfolio of stocks, bonds, or mutual funds, you are probably receiving dividends and interest from those investments. That income is taxable, but there are strategies for minimizing the tax hit. One strategy is to hold investments that pay qualified dividends instead of ordinary dividends. Qualified dividends are taxed at the lower capital gains rate instead of the ordinary income rate. This can make a big difference in how much tax you owe on your investment income. Another strategy is to hold investments for more than a year so that any gains are taxed as long-term capital gains rather than short-term capital gains. Short-term gains are taxed at your ordinary income tax rate, which can be significantly higher than the capital gains rate. If you have a lot of money in taxable brokerage accounts, you might also want to consider converting some of your traditional IRA money to a Roth IRA. Yes, you will owe income tax on the conversion, but once the money is in a Roth IRA, it grows tax-free and you do not have to pay taxes on withdrawal. In retirement, and you do not have to take required minimum distributions from a Roth IRA, which means the money can keep growing for as long as you live. This is something that requires careful planning. You do not want to convert so much money in one year that you push yourself into a higher tax bracket. But done strategically over several years, a Roth conversion can be one of the most powerful tax planning strategies available to seniors. Let me now talk about something that a lot of seniors miss: the deduction for legal fees. If you pay for legal services related to your tax situation, those fees might be deductible. This includes fees paid for tax preparation, tax advice, and tax litigation. If you are dealing with an IRS audit, or if you are trying to resolve a tax dispute, the legal fees you pay might be deductible. This is not widely known, but it is clearly allowed under the tax code. Another overlooked deduction is the deduction for hobby expenses. If you have a hobby that generates some income, like crafting, gardening, or collecting, the expenses you pay for that hobby might be deductible. The key is that the hobby must be engaged in for profit. That does not mean you have to make money. It means you must have a genuine profit motive. If you can show that you are trying to make money from the hobby, even if you have not made any money yet, you can deduct the expenses. For example, if you are an artist who sells paintings at craft fairs, you can deduct the cost of your art supplies, your booth fee, your travel expenses, and your advertising costs. This can be a valuable deduction for seniors who have creative hobbies and earn a little money from them. Are you keeping up with all of this? I know there is a lot to take in, but every single one of these topics could save you money. Take your time. Go back and watch any section again if you need to. And remember that you can always pause the video and come back to it later. Now let me talk about something very important: how to actually claim these benefits when you file your taxes. I am going to walk you through the specific steps so that you know exactly what to do. First, gather all your income documents. This includes your W-2 forms from any employers, your 1099 forms from any freelance or contract work, your 1099 forms for Social Security benefits, your 1099 forms for IRA distributions, and any other documents that show money you received during the year. Second, gather all your expense documents. This includes receipts for medical expenses, property tax statements, mortgage interest statements, charitable contribution receipts, and any other deductible expenses you paid during the year. Third, figure out your filing status. Are you single or married? Are you filing jointly or separately? Your filing status affects your standard deduction amount and your eligibility for various credits. Fourth, decide whether you will take the standard deduction or itemize. This is one of the most important decisions in tax planning. Add up all your potential itemized deductions, including mortgage interest, state and local taxes, charitable contributions, and medical expenses. Compare that total to the standard deduction for your filing status. Take whichever is larger. Fifth, calculate your tax using the appropriate tax brackets. Do not assume you are in a higher bracket than you actually are. Many seniors who think they are in a high tax bracket actually qualify for lots of deductions that bring their taxable income down significantly. Sixth, look for any tax credits you might qualify for. This includes the credit for the elderly or the disabled, the child tax credit if you have dependent children, the earned income tax credit if you have earned income, and any other credits that might apply to your situation. Seventh, complete and file your return. If you do your own taxes, use a reputable software program that is designed for seniors. Many of the big tax software programs have versions specifically for seniors that walk you through the process step by step and help you identify deductions and credits you might otherwise miss. If you hire a tax preparer, make sure you ask specifically about senior tax benefits. Tell them your age. Tell them about any medical expenses you had. Tell them about any charitable giving you did. Ask them if there are any deductions or credits you might be missing. A good tax preparer will know about the senior benefits, but not all tax preparers are good, and some are simply not paying attention. Do not be afraid to ask questions. You are paying them for a service. You deserve to get the best outcome possible. If you found this video helpful, if you feel like you learned something important today, please hit the like button. That is the best way to support this channel and to help other seniors find this information. And leave a comment and tell me what you thought. I read every comment and I will be responding to as why as I can. Now let me talk about something that a lot of seniors struggle with, the alternative minimum tax. This is a separate tax system that was designed to make sure wealthy people pay at least a minimum amount of tax, but it can also affect seniors who have certain types of deductions. The alternative minimum tax works by adding back certain deductions into your taxable income. If the result is that you owe more tax under the alternative minimum tax than you owe under the regular tax system, you have to pay the difference. This can be confusing and frustrating, but there are ways to minimize the impact of the alternative minimum tax on your tax situation. One strategy is to be careful about when you claim certain deductions. Some deductions are not allowed under the alternative minimum tax. If you claim them in a year when you are subject to the alternative minimum tax, they provide less benefit than you expected. A tax professional can help you plan your deductions to minimize the alternative minimum tax impact. Another strategy is to consider spreading out large deductions over several years instead of taking them all at once. This can help you avoid triggering the alternative minimum tax in any single year. Let me now talk about something that affects seniors who are thinking about taking distributions from their retirement accounts. Required minimum distributions. Here is what you need to know. Once you reach a certain age, the IRS requires you to take distributions from your traditional IRA and your 401k. This is called a required minimum distribution. The age has changed recently, so check what the current rule is for your situation. The idea is that the government wants to collect tax on the money you saved over the years. They do not want you to keep deferring the tax forever. The amount you have to take out each year is calculated based on your account balance and your life expectancy. If you do not take the required amount, you face a penalty. The penalty is steep. It can be as high as 50% of the amount you should have taken but did not. But here is a strategy that many seniors use. If you do not need the money from your required minimum distribution, you can donate it directly to a qualified charity through a qualified charitable distribution. I mentioned this earlier. The money goes from your IRA to the charity. It counts toward your required minimum distribution, and it does not count as taxable income. This allows you to satisfy the required minimum distribution requirement while avoiding income tax on the distribution. It also allows you to give money to charity. It is a powerful strategy. If you are subject to required minimum distributions and you give to charity, this is something you absolutely need to look into. Talk to your tax preparer. Talk to the financial institution that holds your IRA. This could save you thousands of dollars in taxes. Before we wrap up, let me remind you about something important. Tax laws change. What is true this year might not be true next year. Credits get expanded or eliminated. Deduction limits get adjusted. Tax brackets get revised. That is why it is so important to stay informed. Subscribe to this channel and check back regularly for updates on tax law changes that affect seniors. Now let me talk about one more thing before we finish. The filing deadline. Most people have to file their taxes by April 15th. But there are some exceptions. If you are a senior and you are on a fixed income, you might qualify for an extension. An extension gives you more time to file, but it does not give you more time to pay. You still have to pay what you owe by April 15th, or you will face interest and penalties. If you cannot pay what you owe, do not just ignore it. Contact the IRS. They have programs for people who cannot pay their tax bill in full. You might be able to set up an installment agreement that allows you to pay over time. Or you might qualify for an offer in compromise, which is an agreement to pay less than the full amount you owe. These programs exist. They can help. Do not be afraid to use them. Also, if you are over 65 and you cannot afford to pay someone to prepare your taxes, there are free tax preparation programs available. The IRS sponsors something called the Volunteer Income Tax Assistance Program. There are also programs run by AARP and other organizations that provide free tax preparation for seniors. These programs are staffed by trained volunteers who know the senior-specific tax benefits. If you have been paying someone to do your taxes and you cannot afford it, look into one of these free programs. You might be surprised at how much help is available. Let me give you a quick summary of everything we covered today, so you have a clear action plan. Number 1, check your standard deduction. If you are 65 or older, you get a higher standard deduction. Make sure your tax preparer is using it. Number R2, check your eligibility for the credit for the elderly or the disabled. This credit can be worth thousands of dollars. Do not miss it. Number 3, keep track of all your medical expenses. The deduction for medical expenses can be very valuable if your expenses are high. Number 4, look into your state senior property tax programs. These vary by state, but they can save you a lot of money. Number 5, if you are over 70 and a half and you have an IRA and you give to charity, look into qualified charitable distributions. This can be one of the most powerful tax strategies available to you. Number 6, if you are selling your home, make sure you know about the capital gains exclusion. You might be able to keep hundreds of thousands of dollars tax-free. Number 7, if you are still working, make sure you are claiming any deductions for work expenses or self-employment expenses. Number 8, if you have investments, review your portfolio with a tax professional to see if there are ways to reduce your tax bill through strategic investing. Number 9, if you are subject to required minimum distributions, consider using a qualified charitable distribution to satisfy the requirement while avoiding taxes. Number 10, if you need help with your taxes, look into free tax preparation programs for seniors. There is no reason to pay for tax preparation when free help is available. This has been a long video, but I have covered a lot of ground. These are real benefits. These are real dollars. These are things you qualify for under the law. You worked hard your whole life. You paid into the system. Now it is time to take advantage of every benefit that is available to you. Do not be embarrassed to ask questions. Do not be embarrassed to ask for help. Millions of seniors are in the same situation as you. They do not know about these benefits. They are overpaying their taxes. You do not have to be one of them. Now that you know, you can do something about it. Thank you for watching. If this video was helpful, please share it with someone who needs to see it. Hit the like button, subscribe to the channel, and check back for more videos about senior finances. I will see you in the next one. This video is for educational purposes only. Tax laws are complex and they change frequently. The information in this video is based on current laws as of the recording date, but it may not reflect the most recent changes. Always verify tax information with a qualified tax professional before making any decisions. The specific benefits you qualify for depend on your individual situation, including your income, your filing status, your state of residence, and other factors. Do not make tax decisions based solely on what you see in a YouTube video. Talk to a licensed tax professional who can review your specific situation and give you personalized advice. The IRS and most states have free resources available to help seniors understand their tax obligations and identify credits and deductions they may qualify for. Use those resources. Ask questions. Get help. You deserve to keep every dollar you have coming to you.